On Point with Craig's Investment Partners.
All right, good morning, all. Remember, as always, the information provided here is general in nature. It's not financial advice. It doesn't take into account your situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So, before you make any investment decisions, we recommend you contact an investment advisor. And you can find more out about what we do in that regard at our website, which is craigsip.com. Okay, another week down, another busy one coming up. Let's recap some of the market movements. Then we'll recap some of the key events from last week. Then we'll do a bit of a look ahead to what you need to keep an eye on. Last week was a bit of a difficult one for global share markets. And the month of May, as I spoke about a week ago, is so far living up to its name as one of the more challenging ones for share markets around the world. We had the S&P 500 in the US down 0.8%. Would have been down further, but there was a very strong rebound on Friday night. The Friday trading session was a very strong one. Apple shares, which reported the previous day, performed very well, and there was a bit of a relief rally. Let's see how that lasts in the days ahead. But that didn't save the market from a negative week. So the US down 0.8%. The European markets were down more modestly, down 0.3%, the UK down 1.2%, Australia and New Zealand both down a little more than 1% for the week. What I would point out is that NZ and Aussie both closed before we had that strong US recovery on Friday night. So we might begin this week on a slightly stronger footing with a bit of catch up to play for today, at least. We'll see how we go. Interest rates, the US 2-year Treasury yield fell slightly, fell from 4% to 3.9. The 10-year little changed, it's sitting at about 3.4. The New Zealand 5-year swap rate down marginally. And fixed income has been performing well. The NZX Corporate Bond Index, which is a good proxy for what many investors have in their fixed income portfolio or fund. That index added 0.3% for last week, and it's up about 3.5% so far this year. So it's actually performed in a very similar way in terms of the year-to-date returns, at least, to the NZX 50 share market index. Regional banks are still in the spotlight over in the US, still been under a lot of pressure, and there are still fears amongst many investors that you could see others suffer a similar fate as Silicon Valley Bank, Signature Bank, both of which, those are the two that collapsed in March, and there's been others that have found themselves in a difficult spot since then. Like I said, there was a rebound on Friday night, but the regional banks are still doing it tough, and the regional banking ETF, which is a good proxy for how people are feeling about the sector, still down another 10% last week, and it's down almost 35% so far this year. So that sector is still very much in the spotlight and under pressure. Looking back at the key events of last week, we'll start locally. It was a really busy one, so I'll try and whiz through this without dwelling on anything because we'll be here all day. But we had our March 2023 quarter labour force report, so basically unemployment, and it was pretty good. It reflected a strong labour market that is still very tight. So employment growth was strong. The headline unemployment rate was unchanged at 3.4. People were expecting it to increase slightly, but it just went sideways. That's very close to the multi-decade low of 3.2% that we saw about a year ago, and it's definitely above maximum sustainable employment, which is obviously what the Reserve Bank is targeting. So very tight labour market and at levels where you're not going to have inflation under control, and you're probably running a little bit beyond your capacity. The detail also looked good. The participation rate increased slightly. So that's now at the highest we've seen since the data collection began in 1985 at 72%, I should say. That's probably a couple of things. It's probably people entering the labour force because opportunities are there. Wages are looking quite good, and so that's attracting people back in. And a lot of people are probably feeling like they have to return to the labour force because of the cost of living pressures. The underutilisation rate, which is a broader measure of labour market slack, that includes things like people, they might be employed, but they're only working part-time. They really want to be working full-time. So it's a bit wider. That was 9% during the March 2023 quarter, which is the lowest we've seen since as far back as the data goes, which is a little more than a decade. So that looks strong too. Wage growth, it increased again through the quarter, and it picked up the pace from what we saw in this December 22 quarter. But it's still below where it was tracking through the middle of last year. And on an annual basis, average hourly earnings up 8.2%. Extremely high. Good news, keeping pace with the cost of living. Bad news, creating inflation, which means the Reserve Bank is still, very keen to keep monetary policy tight, and probably it will probably get tighter. So 8.2%, that is not far off the levels that we saw in September, which was the highest that we'd seen since they started tracking that back in 1990. So more of the same, really, when it comes to the labour market in New Zealand. It's good for workers, it's not so good for businesses, and it is still at levels that we would consider inflationary. So nothing in there in terms of good news from a Reserve Bank perspective. Dairy prices, we had another gain last week, so the second consecutive auction where prices went up. That's good. We haven't seen two increases in a row since last year. However, prices still down 3.8% this year, and down about a third from the 15-year highs that we saw in March last year. So where's Fonterra at the moment? They have cut their payout range a couple of times this year, and at the moment it's sitting at $8 to $8.60. So I feel like it could well end up near the bottom of that range, but time will tell. We also had the Reserve Bank's financial stability report, and that's definitely worth a read. The press conference, which you can find online, definitely worth a watch. It talked about global inflation pressures, the monetary policy tightening that we've seen, the impacts that those things will have on households and so forth, particularly those that have high debt levels. The Reserve Bank is still looking ahead and sees a key risk as those people that still need to fix mortgages at higher rates. So you've still got that lagged effect coming through. It noted that we hadn't seen too much distress there, but there was a risk that if you see a rise in unemployment, that could change. What else did they talk about? They talked about the banks and how they're comfortable with the banking sector. Capital and liquidity positions are still strong. Banks are profitable. Asset quality is high. So none of the concerns that we're seeing overseas, but commercial property, the agricultural sector, those are two areas of the economy where there are risks, and I suspect that is because there are parts of those sectors where the debt levels are quite high. So that was not unexpected in terms of the things that the Reserve Bank talked about as risks to the financial system. Overseas, it was a busy one. We had three central banks meet, and they all increased interest rates. Two of those increases were expected. That was the Federal Reserve in the US, which hiked interest rates by 0.25%. So their Fed funds rate, the upper bound at least, because they do a range rather than just a point, the upper bound of the Fed funds rate is at 5.25. So that's the highest since 2007, and that's actually as high as the Fed funds rate got back in that pre-GFC period. To find a time, so we're now equal with the peak of the pre-GFC period. To find a time where it was higher than it is now, you've got to go right back to early 2001 before before 9/11, before the terrorist attacks. So it is the highest we've seen for some time. Looks like that's it. I think unless something unexpected happens, then that is probably the last hike in the cycle, and that I think you'll see the Fed pause for now. That was what they indicated in their statement. When you sort of look at the change in tone and the type of comments that we saw in the press conference. So it's always a watch this space, and you never know. Inflation could rise again, or something could happen, and they could find themselves hiking a little bit more. But from what we know today, and reading between the lines, that in all likelihood means the Fed is done. So the next question becomes, how long do they leave it where it is, and when do they sort of reduce interest rates? And that's a big debate in financial markets at the moment, because financial markets are already factoring in cuts in the not too distant future. And it's possible that the market's just a little bit optimistic about that. We might see the Fed, even though they're not hiking rates anymore, they might just stay put for a longer time than the market is hoping. So still a bit of a disconnect in terms of what the Fed is suggesting it will do, and what some think it will do, and where the market pricing has moved to. So the Fed hiked. That was expected. The European Central Bank also hiked. They increased their rate again by 0.25%. So that sees them at 3.25. That's the highest since 2008. And like the Fed, that was as high as they got in the GFC period. They'll go higher though. I think there's another one or two at least in the pipeline. So they'll probably end up at 3.75. So the peak this cycle will be higher than the peak we saw last time. The third one was the Reserve Bank of Australia, and they were expected to just sit tight because in April, they meet monthly, so we hear from them a lot more regularly than we do the Fed or the Reserve Bank of New Zealand or the ECB in Europe. And the RBA sat tight in April, so everyone thought they would sit tight again in May, but they didn't. They moved. They increased their cash rate by 0.25%, so it's now at 3.85. So a little below New Zealand and the US, but still the highest since 2012. And back then, in that period, they got as high as 4.75. They probably won't get quite that high this time. In fact, a lot of people think that the one we saw last week will be the last one, but time will tell. That really took markets by surprise, and I think that's why you sort of saw a bit of nervousness in New Zealand and Australia middle of last week, because the market didn't see that coming. They're obviously a little bit more cautious about inflation than people had thought, and felt the need to just do a little bit more. On the economic front, we had some important data points come out of the US. We had the ISM indices, so you get one for the manufacturing sector, one for services. The manufacturing one improved marginally in April, so it's sitting at 47.1. That's still below 50. 50 is your break-even level, so that's the 6th month in a row we've been below 50. So manufacturing is at a bit of a slump in the US. And other details were a bit mixed as well. Inflationary indicators, some good, some bad. But the services sector still performing a lot better. So manufacturing quite weak, services not super strong, but at least above that break-even point, sitting just below 52. So that's definitely below what we've seen in the post-COVID period. In fact, that's the third weakest month we've seen since the first half of 2020. But above 50 is above 50. That's 50. That signals expansion. So not too bad, but not super strong. The jobs report in the US was probably a little more impressive. The US economy added 253,000 jobs for the month. Ahead of forecast for 185, and the highest in 3 months. They did revise the previous 2 months lower, so that's why it's higher than we thought. Unemployment declined from 3.5 in March to 3.4% in April. So like New Zealand, super low. That's equal with January, which was a 54-year low, so the lowest since 1969. So it's a similar story there as it is here. Very tight labour market. probably running a little hotter than the economies should be running at. Certainly, if you're trying to keep inflation at reasonable levels. So, good news in there from the perspective of the economy being resilient, but whether it probably tells us that don't get excited about the Fed sort of backtracking anytime soon, because it does point to resilience across the labour market, which has obviously been a really important piece of the inflation puzzle. Looking ahead, let's start locally. We've got the RBNZ quarterly survey of expectations. So this is where they go out and survey, economists and forecasters and so forth about what they expect inflation to do. And it's quite an important survey because the Reserve Bank does take people's expectations around inflation into account when it's doing its thinking. So in recent times, we've seen short-term inflation expectations quite high, but when you look out sort of 5 years or even 2 years, they are more modest, and that suggests that people still believe. Well, everyone knows we've got an inflation issue at the moment over the short term. People still have that confidence that the Reserve Bank has strong inflation fighting credentials, and that they will get inflation back down to acceptable levels. So we'll be watching for the update there. We might get a housing market report. I've got this sort of on my list. The REINZ might release their April housing report late in the week. It usually comes out about sort of, business day 9, 10 or 11. So, you might see it on Friday-ish, or it could end up this time next week. So we'll just have to wait and see. But that's something to look out for. We're obviously looking for signs of stability across the housing market after a pretty lengthy period of weakness. Maybe there's a bit more downside across the market, but one would think that we're very much past the worst there. Prices and nationally are down almost 17% from the peak, and in Auckland they're down 22% from the peak. So most of that is behind us, but we'll be looking for any clues to either confirm or deny that. So we'll just have to see if that actually comes to fruition. In the US, we have got a few things to watch. The highlight in an economic sense will probably be the April Consumer Price Index. That's due Wednesday. Markets are expecting it to increase 0.4% for the month. That'd see the annual inflation rate at 5%, which would be the same as March, which is the lowest since May 2021 and well below the peak this cycle. So, it's good news. 5 is better than 9.1, where it was in June last year. The core CPI, which excludes food and energy, expected to increase again for the month to the tune of 0.3%. But the annual rate of core inflation expected to slip marginally to 5.5. I think it was 5.6 last month. So going in the right direction. This is probably increasingly important now because, as I mentioned, the Fed is probably pausing, but they have become quite data dependent. So, all other things being equal or all going to plan, they're done. But, if you get some indications that inflation is rising again, that's what could sort of push them into maybe thinking, well, we need to hike rates, another 1 or 2 times. So I think we'll all focus on the data a lot more now, the inflation data, the labour market data, because that's what the Fed's doing. The Fed has done the vast bulk of its rate increases, and it will probably just plateau from here. Interest rates will. But the data becomes much more important because that will determine where they go next. So that'll be something to watch, and that will come through on Wednesday. We'll also be watching the Senior Loan Officer Opinion Survey, and that is that's a survey that gives us some really good clues about credit conditions and sort of those sorts of things. I think that's important because of what we've seen in the banking sector. So we want to see how tight credit conditions have got as a result of banks sort of reining in that lending and becoming a bit more fussy about who they're lending their money to. So because of what you're seeing in the banking sector, we're watching that. Also in the US, we've got President Biden meeting congressional leaders on Tuesday to talk about the US debt ceiling. Janet Yellen, who's now the Treasury Secretary, warned last week that it could be hit by the 1st of June, which is a little earlier than expected. That always creates a bit of drama across markets, across, a bit of nervousness. It is as much a political issue as it is, anything else. And it always gets resolved, but on the way through, it can create volatility and mayhem if the politicians can't sort of get their act together and periodically raise it as they should. In the UK, we have got Monday's a bank holiday for a start, following the coronation of King Charles, which is taking place this weekend. It'll all have happened by the time you hear this. So Monday is a holiday. The Bank of England is expected to hike interest rates again on Thursday. So we'll be watching that. And then we've got the UK GDP figures that are coming out on Friday. I probably won't be watching that coronation, although I'm sure it will be good tonight. I'm recording this on Saturday afternoon, and I think it all happens tonight. But Magic Round in the NRL, so I'll have to keep an eye on that. I'm a big rugby league fan. For those that don't know me, that's my sport, and got some big games tonight, so they're quite important for my my NRL fantasy team that I run, and I'm against one of my colleagues, Jack, from our Auckland office this week, and he's a bit of a gun. He's pretty good, so there's a lot riding on the games tonight. So maybe I'll just catch the end of the coronation after those matches have taken place. But it's a big event, and you would think that will dominate the news in the UK over the coming week. But other than that, it's the Bank of England and GDP. Across the Tasman, we've got the Aussie budget. This is out on Tuesday evening, so this will be the federal budget. I think it comes out on Tuesday at 7:30 Aussie time, so it's about 9:30 New Zealand time if you're interested in watching that. Not expecting it to have massive implications for the Reserve Bank of Australia. But there could be some sectors of the share market that will benefit from additional spending initiatives. We're likely to see some cost of living relief, as we'll see in our budget later this month. So you could see some of that spending impact sentiment for some of the market sectors across there. Generally, Australia's fiscal position has improved dramatically since COVID. They've had very good prices for some of their key commodities: iron ore, coal, natural gas. So you'd expect things to look quite decent across the Tasman in terms of how that is tracking. In terms of the earnings releases, there's a few more to come internationally, but we are in that sort of wind down part of the quarterly earnings season. 85% of the US market has already reported results, and it's been pretty good. 78% of companies have beaten earnings estimates, and people aren't expecting this quarter or the March quarter to be as terrible as they had been expecting. So, look, it's been a pretty solid reporting season. A few more to come, though, even though we're at the tail end. I think we've got PayPal tonight. That's Monday. Walt Disney, the other big one, I think they're on Wednesday, and there's a few others from other parts of the world. Nintendo, Saudi Aramco, Rivian. So a bit to keep an eye on. Across the Tasman, there's a few as well. Who we got? We got CSR, the building products company, on Wednesday. GrainCorp, Orica, Ampol, and QBE holding annual meetings. So the few bits and pieces in terms of corporate news coming from across the Tasman. Not a lot here in New Zealand, but that will change next week and the following week, where we will have a few corporates reporting. So there'll be a few things to watch. Okay, that's probably all for this week. I hope that's useful. Enjoy your financial markets week, and as always, if anything that I've said resonates, if it makes you think, if you want to know more about any of these companies, topics, or market issues, then in all likelihood we have some research material that we can give you. So we always love to talk to existing clients if they want more from us, or new clients or potential new clients that we haven't spoken to. So don't be afraid to touch base with any of us. We have 180 odd advisors right up and down the country that are all very, very capable of helping you achieve your goals. So don't be shy. But as far as this is done, that's me, and we will talk again in a week's time, if not sooner. Thanks for listening.
For more insights, visit craigsip.com.